Hey everyone. Welcome to my channel. I'm so excited to have you here. Whether you're a returning subscriber or brand new, you're in the right place for amazing content that can help you grow and succeed. Before we dive in, make sure to hit that like button, subscribe, and share so you never miss an update. Your support means the world to me and helps this community grow. Now, grab a seat, relax, and let's jump right into today's video. Why investing is crucial for your financial future. Investing is one of the most powerful tools for building wealth, yet many beginners hesitate to start. Why? The most common reasons are fear, confusion, or simply a lack of knowledge. The financial world can feel intimidating, filled with complex terms, fluctuating markets, and endless options. But here's the truth: the sooner you start investing, the more you benefit from long-term growth and the power of compounding returns. Think of investing as planting a tree. If you plant a seed today, nurture it, and give it time, it grows into a strong, towering tree that provides shade and fruit for years to come. The earlier you plant the seed, the bigger and stronger the tree becomes. Similarly, the earlier you start investing, the more your wealth grows over time. Now, you might be wondering, why should I start investing in 2025? This year offers more investment opportunities than ever before. With advancements in technology, access to diversified asset classes, and automated financial tools, entering the market has never been easier. Unlike previous generations, who had to rely on financial advisors or brokers, you can now manage your investments from your smartphone with just a few taps. However, before diving in, it's crucial to understand the fundamentals. What should you invest in? How do you minimize risk? What strategies work best for beginners? These are important questions that we'll explore step by step, helping you build a solid financial strategy tailored to your goals. So, let's begin by answering the first and most important question: why should you start investing right now? Why you should start investing now? The biggest reason to start investing today is simple: wealth growth and financial security. Many people assume that keeping money in a savings account is enough to secure their financial future. While saving is important, it's not enough to build wealth. Why? Inflation. Inflation gradually erodes the purchasing power of money. A dollar today won't buy the same amount of goods in 10 years. Imagine you have $10,000 sitting in a bank account with an interest rate of 1%. Meanwhile, inflation is rising at an average rate of 3% per year. In a decade, your money will have lost significant value. It will buy less than it does today. On the other hand, investing allows your money to grow at a higher rate than inflation. Investments in assets like stocks, real estate, and bonds historically outpace inflation, ensuring that your wealth increases over time rather than shrinking. The power of compound interest. One of the most important concepts in investing is compound interest, often called the eighth wonder of the world by financial experts. So, what is compound interest? It's when your earnings generate additional earnings over time. Think of it as a snowball rolling down a hill. Initially, it's small, but as it rolls, it gathers more snow and grows bigger. This is how investing works. Let's break it down with an example. If you invest $1,000 today with an annual return of 10%, after 1 year, your money grows to $1,100. In year 2, you don't just earn 10% on your original $1,000, you also earn 10% on the $100 you gained in year 1. Your investment grows to $1,210. Over 30 years, without adding any extra money, that initial $1,000 grows to nearly $17,500, all thanks to compounding. Now imagine if you invested $500 per month in addition to your initial amount. The results would be life-changing. Multiple streams of income. Investing also allows you to diversify your income. Many people rely on a single income source, such as a job or a business. But what happens if you lose your job? Or if your business struggles? When you invest, you create multiple income streams. For example, dividend stocks pay you regular income just for holding shares. Real estate generates rental income. Bonds provide interest payments. Cryptocurrency staking offers rewards for holding certain digital assets. Having multiple income streams reduces financial risk and gives you greater stability. Defining your financial goals and risk tolerance. Before you invest a single dollar, you need to ask yourself two crucial questions. What are my financial goals? How much risk am I willing to take? Setting clear financial goals. Every investor has different reasons for investing. Some want to build a retirement fund, buy a house, achieve financial independence, generate passive income. Clearly defining your goals helps you choose the right investments. For example, if you're saving for retirement, you'll want long-term investments like index funds. If you're saving for a house in 5 years, you might prefer low-risk investments like bonds or high-yield savings accounts. Understanding risk tolerance. Risk tolerance is how much risk you're comfortable taking with your money. Every investment carries some risk, but different investments have different levels of risk. If you prefer stability, you might choose bonds, index funds, or dividend stocks. If you're comfortable with higher risk, you may invest in growth stocks, crypto, or startups. A good rule of thumb is to invest in a mix of assets, balancing high-risk, high-reward options with safer, stable investments. Now that you know why investing is important and how to set your financial goals, let's explore the best investment strategies for beginners. Best investment strategies for beginners. Now that you understand why investing is essential and how to set financial goals, the next step is learning where and how to invest. Beginners often feel overwhelmed by the countless investment options available. However, some strategies have been consistently effective in minimizing risk while maximizing returns. Let's explore the best investment options for beginners and how to build a solid portfolio. 1. Low-cost index funds. The easiest way to build wealth. One of the best investment choices for beginners is low-cost index funds. What is an index fund? An index fund is a type of investment that tracks a specific market index, such as the S&P 500, which includes the 500 largest U.S. companies, the Nasdaq 100, which focuses on tech companies, the Dow Jones Industrial Average. Instead of investing in individual stocks, an index fund lets you own a little piece of hundreds or even thousands of companies with a single purchase. Why choose index funds? Diversification reduces risk by spreading your money across many stocks. Low fees, managed by algorithms, making them cheaper than actively managed funds. Steady growth. Historically, the S&P 500 has returned around 8 to 10% annually. No stock picking needed, no need to analyze individual companies, just invest and let it grow. Many successful investors, including Warren Buffett, recommend index funds as the easiest and safest way to build wealth. If you're looking for a set-it-and-forget-it strategy, index funds are the way to go. Exchange-traded funds, ETFs. A flexible investment option. ETFs, also known as exchange-traded funds, function similarly to index funds but offer greater flexibility. What is the difference between ETFs and index funds? Index funds are bought once per day at a fixed price. ETFs can be bought or sold throughout the day, just like stocks. Why choose ETFs? Liquidity. ETFs allow you to buy and sell shares at any time during market hours. Diversification. A single ETF provides exposure to multiple companies, reducing risk. Cost-effectiveness. ETFs typically have lower fees compared to actively managed mutual funds. ETFs are an excellent option for beginners seeking diversification and flexibility while keeping costs low. Dividend stocks. Earning passive income. Dividend stocks represent shares in companies that distribute regular cash payments to investors. This allows you to earn passive income without selling your shares. Why invest in dividend stocks? Passive income. Investors receive quarterly or annual dividend payments regardless of stock price fluctuations. Lower volatility. Companies that pay dividends are often well established and financially stable. Compounding growth. Reinvesting dividends accelerates portfolio growth through the power of compounding. Example of dividend investing. An investment of $10,000 in a stock with a 5% annual dividend yield generates $500 per year in dividends. If these dividends are reinvested, the investment compounds over time, leading to significant wealth accumulation. Well-known dividend-paying companies: Coca-Cola, Johnson & Johnson, Procter & Gamble. For those seeking stability and passive income, dividend stocks offer an attractive long-term investment strategy. Robo-advisors. Automated investing for beginners. For individuals who prefer a hands-off approach to investing, robo-advisors provide an automated solution for portfolio management. What is a robo-advisor? A robo-advisor is an AI-powered platform that manages investments based on an individual's financial goals and risk tolerance. These platforms use algorithms to buy and sell assets efficiently, removing the need for manual intervention. Why choose robo-advisors? No experience needed. Robo-advisors simplify investing for beginners. Low fees. Costs are significantly lower compared to hiring a human financial advisor. Automatic diversification. Investments are spread across various assets to minimize risk. Hands-off investing. Once the initial setup is complete, the platform operates autonomously. Popular robo-advisors. Betterment Wealthfront M1 Finance for investors seeking a stress-free and cost-effective way to grow their wealth. Robo-advisors offer an excellent alternative. Real estate investing. Building wealth through property real estate investment is a proven strategy for wealth accumulation. While purchasing property requires substantial capital, there are alternative ways to invest in real estate without owning physical buildings. Ways to invest in real estate: rental properties. Purchasing a house or apartment and renting it out generates passive income. Real estate investment trusts. REITs. Investing in real estate companies allows exposure to the property market without the need to own physical assets. Real estate crowdfunding. This option enables investors to pool resources and invest in real estate projects with smaller amounts of capital. Why invest in real estate? Appreciation. Property values generally increase over time, contributing to long-term wealth growth. Passive income. Rental income provides a consistent revenue stream. Inflation protection. Real estate investments often retain value and adjust with inflation. For individuals interested in real estate investment but lacking the capital to purchase property, REITs and real estate crowdfunding offer accessible alternatives. Building a bulletproof investment strategy. Now that you know the best investment options, let's talk about how to structure your portfolio for long-term success. The power of dollar cost averaging, DCA. Dollar cost averaging, DCA, is a strategy where you invest a fixed amount of money at regular intervals regardless of market conditions. Example: you invest $100 every month in an index fund. When prices are high, you buy fewer shares. When prices are low, you buy more shares. This strategy eliminates the stress of market timing and reduces risk by averaging out the cost over time. Emergency fund, your financial safety net. Before you start investing, you must build an emergency fund. If you don't have savings and an unexpected expense arises, such as medical bills, car repairs, or job loss, you might be forced to sell your investments at a loss. How much should you save? At least 3 to 6 months of living expenses in a high-yield savings account. Once you have an emergency fund, you can invest with peace of mind, knowing that short-term setbacks won't derail your long-term strategy. Maximize retirement accounts, 401k and IRA. If your employer offers a 401k plan, always contribute enough to get the full match. Example: if your employer matches 100% of your contributions up to 5% of your salary, that's free money. Take advantage of it. For additional tax benefits, open an IRA, individual retirement account. Traditional IRA, contributions are tax-deductible, but withdrawals are taxed. Roth IRA, contributions are taxed upfront, but withdrawals are tax-free. The earlier you start, the more time your investments have to grow tax-free. Final thoughts: start investing today. Successful investing isn't about chasing quick gains, it's about patience, discipline, and consistency. Market fluctuations are normal, but if you stick to your strategy, you'll see significant growth over time. The best time to start investing was yesterday. The second best time is today. Take action now. Set your financial goals. Choose your investment strategy. Start small and invest consistently. Stay patient, informed, and committed, and watch your wealth grow in 2025 and beyond.